Buy these 5 stocks now for huge profits in 2023. Emergency webinar. Central banks are printing money. Year to date, our total return is 27.5%. Total return since conception from 2021 to 2023 is 286%. That means we're outperforming the S&P 500's 11% return by 2,518%. Here's our high-risk portfolio allocation right now. Now, again, if you're a paid member, you can log in and input how much you want to invest, and our calculator will automatically tell you exactly how many shares of each ETF or stock to purchase. Currently, 1 unit of investment costs $3,985 and is made up of these 5 stocks in this ratio of shares. Step 1, buy 42 shares of UVXY. This is the stock crash insurance play. Step 2, buy 98 shares of TMF. This is the long end of the US Treasury curve, betting that interest rates are going to fall as the economy slows down and inflation slows down for the next 6 to 12 months. That's on the defensive side. On the offensive side, we have 17 shares of Coinbase. This is the bet that government's going to spend more money than they make indefinitely, dilute the value of currencies globally, and make digital currencies go up in value exponentially. This is our favorite growth play, laser targeted at the US centralized exchange Coinbase, 17 shares. Next, big play on AI. You've noticed a handful of stocks have been leading the stock market up while the rest have been flat or down. It's the big tech companies investing heavily in AI, which is about to dramatically change the world we live in. With FNGU, you have 3 times exposure to the giant tech companies that are going to be responsible for the AI revolution. Finally, you need an inflation hedge. Oil's been creeping back up over the last month, and we've hedged our portfolio with NRGU. This is the top 10 US oil and gas companies times 3. So that's what we're looking at in our portfolio. In another month or two, we'll likely start to cut back on treasuries, coin, and FNGU and double down on oil. That's a trade alert I see coming. Once we think the Fed's going to pause, it does look like the Fed will not pause in May because we still have a strong labor market and inflation's still a little too sticky. If we look at the monthly breakdown, the first month we launched in 2020 in December, returned 4.72%. 2021, we had a great year, a 233% return. 2022, we were up as much as 60% and then gave a lot of it back at the end of the year when we had commodities and treasuries implode on us. This year, we're doing really good, up 27.5% year to date. Now, if you want to be a little safer and more conservative, we have a second product called Safe Growth Portfolio. This is actually free when you buy our high risk portfolio. The 2 products come together. This portfolio, again, is much more conservative and looking at value plays. Its current unit of investment is $2,319. On the defensive side of the portfolio, we're picking up 19 shares of UVXY, the crash insurance play. We have a massive, this is by far the largest position, treasury play with 114 shares of TMF, again, betting that the economy is going to slow down, inflation is going to fall, and interest rates are going to come back down. This has been taking a while to play out, but that's one of the reasons why it's done well this year, is because this is finally starting to happen, and that represents almost half of the total portfolio. On the offensive side, we're looking at 12 shares of EDC. This is emerging markets, ticker EEM. The outlook for a strong dollar and falling interest rates are the key to being long emerging markets. So we're super excited for the potential for emerging markets to greatly outperform US markets this cycle with the ticker EDC. And again, that leverages you into emerging markets times 3. Finally, GBTC is our play in digital currencies for this product. And this digital currency has been outperforming all others this year and providing a great boost to our return. Furthermore, the Grayscale Trust is trading at a great discount compared to the assets it holds. So it's a killer value play, and essentially our variation in playing the tech stocks for this portfolio. Now, the biggest threat to markets continues to be inflation. So this one has twice the position in inflation hedge in our GU already, with one share representing twice the exposure in the other portfolio at 19.5%. At some point this year, we'll very likely take some profits off of treasuries and reallocate it into some of the offense. At this point, I don't see this portfolio budging much at all in the near term. This return has a 25% return in 2019. 2020 was crazy with the lockdowns, and we played that year super safe. Still pulled a 4% return. 2021, we returned 25.8%. Last year it was rough. The bonds obviously hurt the portfolio, and we lost 25%. This year we're already back up at 12% with a 3.67% return in April. And again, what's really neat is all of our members get the exact same return because we follow the same ratio. When you have a paid membership, you can log in, input how much you want to invest into each strategy, and it'll automatically print out how many shares to buy. Let's take a look at the most pressing data just in today. We had the inflation print this morning, and the picture remains the same. The services CPI remains way too hot, while core goods has fallen. Despite a little bounce here, you can see it's gone back to the target of 2%. So now we just need core services to fall from the current elevated 6.8% level down to 2. The big question is, when will it do it? Here's a breakdown of US core CPI, and we can see energy and transportation goods, especially motor fuel, actually went negative. Another big drop was medical services. But other than that, we're still seeing shelter in place dominate the majority of the inflation print alongside household supplies. Now, the good news is there's at least a drop coming in shelter in place if we look at the prices on apartment listings and Zillow. So we do expect shelter to begin to shrink for at least the next 6 months. But the problem is we're starting to see those rent prices bounce back up here alongside things like used cars. So it's still being pretty sticky here on the inflation side. Here's a breakdown where we can see the CPI decomposed, and you can see the energy section has the biggest declines, while transportation services, shelter services, primary rent, all running very, very hot. So we're likely actually about to see services cool off and energy come back up because, again, oil's been rising. And now the US can't dump much more of its SPR, Strategic Petroleum Reserve, to help push oil costs lower. Here's a look at the two different core price indexes, headline and core. And you can see the core has somewhat become sticky, while the headline has been falling aggressively for quite some time now. Good news for services is that wage growth has been falling since May. This will eventually slow down the demand for services, and everyone's savings is starting to become depleted. So keep a close eye on PPI on Thursday and retail sales this Friday to see more signs of cooling in the inflation scene. Now, if we look at big picture data, perhaps the most important metric is the change over change of the money supply. This is signaling that we have a good year ahead of falling inflation due to a contraction of the money supply. Again, this was one of the core reasons why the energy section has been falling on the inflation, is the US has dumped almost all of its strategic petroleum reserve. So it went from 700 million barrels down to about 371 today. Now they're talking about trying to refill it up, but just this week they dumped some more oil into the market, helping cool off the rising oil costs. Now, also part of the picture is that OPEC and Russia has dramatically cut down the supply side to drive those prices back up. So now China and the US could try to combat that by, again, releasing some of their strategic reserves. Now, on the growth side, as well as the inflation side, we need to pay close attention to China. We were warning investors that the second US inflation was falling, that China would finally stimulate their economy, which they had locked down for over a year past Western economies. And that's exactly what they've been doing the second US inflation has fallen. The reason why they waited was they were worried about their bond market and currency markets imploding if they were to print money while the US was tightening. So we've got the US about to pause its tightening, and China is printing money like crazy to get their economy back on track. Now, the Chinese credit impulse leads inflation by about 7 to 8 quarters. So everything's looking like we have about a year of deflation. And towards the end of this year or early 2024, we're going to see inflation pick back up rapidly. This is the Fed's balance sheet. The bank blowups caused them to reverse about 2/3 of the quantitative tightening they've done. Now, the US has a big problem. In the first half of the US fiscal year, we've already ran a $1.1 trillion deficit, and they're only planning for them to run around a 1.3 to 1.4. So are they going to hit a $2 trillion deficit this year while trying to do quantitative tightening? This just won't work in the bond market and is going to cause interest rates to rise. So we're going to see how the debt ceiling plays out this summer. What's going to happen when Janet starts selling massive amounts of bonds again into the open market. So expect the risk of volatility when that first begins to happen. Now, again, this will likely be negative for bonds and very good for stocks like oil companies and digital currencies. At some point, to stop the bank crisis, they're going to have to drop the federal funds rate to make the interest rate on money markets go down. And again, what's going to happen is there's $5 trillion sitting in money market funds that's going to rush into either normal bank accounts, the stock market, or bonds. And the key to this will be inflation falling. So once we do get inflation falling, look for a massive melt up in risk assets this year. It's still been too sticky for investors to get confident and for the Fed to signal they're going to pause or drop interest rates. Here's a look at the United States consumer spending. This will get updated Friday. No signs of a recession here. Labor markets remain ultra tight and still growing at a strong clip last Friday with 230,000 jobs added. Below the 300,000 6-month average, but still running hot. None of the predictions the big banks put out last year that we'd have negative employment by now have played out whatsoever. So there's really no signs of a recession looming currently. Balance of trade has cooled off, meaning the US is importing less goods. That's going to help cool off inflation. Retail sales continue to be strong, so no signs of that falling apart. And consumer credit, while dropping over the credit crunch from the small banks collapsing, is still growing. Bank credit still growing. We'll get this updated. We did have a drop in lending from small banks, and we still have a massive problem in commercial real estate. But luckily, that only represents about 1% of the entire US stock market. China's PMI is well above 50, so they are back in action. This will be a deflationary force and help with growth. Chinese exports dropped a little bit in February, but still very healthy. Same with their imports. Okay, let's break down the trade alert step by step. Buy 17 shares of Coin, our ultimate growth asset. Here's a look at Coinbase. They were struck with a Wells notice from the SEC. We believe they'll pay a fine and be just fine, but that dropped their stock from 80 back down towards 62, and we've bounced all the way back up to 70, 69.60 today. This stock has immense growth ahead. We'll be buying and holding this for quite some time in our high risk portfolio. And you can see it from a year ago, it's already down 52%. One of the key assets in this digital currency world is ETH, and it's up 29% in the past month. If we look at the past year, though, it's down 35.9%, showing you it's not even anywhere near recent highs. In fact, the last high was above 4,000, and we're only at 1914. We believe this asset could go towards 10 to 15,000 this market cycle and potentially overtake BTC as the largest market cap. And again, the main reason to be long digital currencies is you believe governments will spend more money than they make. And this is really a fate they cannot get out of without causing massive disruptions to the political framework that we exist in right now, which is filled with lots of free money for everyone. Now, again, you can see in this chart the U.S. federal budget deficit projections for 2023 was 1 trillion. In the first half of the year, we've already ran a $1.1 trillion deficit. So this is on track with what we would expect, spending way more than they make. Now, if you want to learn more about our products and services, call Dean at 505-322-7515. If you're a paid member and you'd like a better position than Coinbase or FNGU for that matter, we have a private equity product that you can learn about that gives you triple leverage into ETH with a weekly dividend. So call Dean to learn more about that at 505-322-7515. And again, it's only for our paid members group. Commodities, buy one share of NRGU, the oil inflation hedge. NRGU is up 28% in the past month after being up 8% in the year to date and down 58% in the past 5 years. We believe this can notch back up towards very high levels soon as the US inflation problems under control and they start to pause interest rates or drop them. So look for me to add NRGU specifically to the high risk portfolio and possibly even more to the safe growth portfolio as soon as we get that pause. It does not look like May will be the pause, but now June. Here's a look at oil rebounding back up. This is what happens when OPEC and Russia cut supply as the US runs out of strategic reserves to release. This will be a great long-term play for us to be long these oil and gas companies as the economy comes back online. Natural gas is another play we like. We made money on it 2 out of 3 times in the last 18 months. The last time we attempted it was a disaster. I see no reason to get back into oil until most likely this winter. Crash insurance, buy 42 shares of UVXY. So the VIX goes up if the S&P 500 goes down, and the trend this year has been to crush the VIX. So we've barely added to the VIX in the last 18 months. Probably the time to do this will be somewhere around when the debt ceiling is lifted. I think in the short term, the massive debt issuance could cause interest rates to rise and create lower valuations in stocks temporarily till she's done raising money. So she's about out of cash at the Treasury General account. They drained it from something like $700 billion down to $150 billion, and they're getting towards the point where they need to refill it. Of course, tax receipts are coming in as we speak, so that'll buy her some time. But if they come in short, the debt ceiling issue is going to become a bigger problem faster. This is the VIX or the UVXY product during the March 2020 lockdowns. And when the S&P 500 fell 25%, UVXY went up 1,000%. So a 10% position doubled your net worth while you only lost 25% on your stocks. This is the 2008 analogy. I'm not so sure this plays out unless we're wrong on the inflation. If the inflation does come back or remains at 5%, the Fed's going to have to hike interest rates way higher than what's priced into the market. So again, we're currently positioned for about 6 months to 12 months of deflation before we're really concerned about inflation returning. And that's based on the Chinese credit cycle as well as the US bond cycle. Bonds, buy 98 shares of TMF, the deflation hedge. This product's been all over the place with banks collapsing, interest rates jumping up and down, and uncertainty as to the Fed's forward path for rate hikes. So in the last month, TMF is down 3.818%. In the past year, it's down 40%. And this is one of the best discounts, if you're patient, that we've ever seen in the bond market. So we're way above any type of normal level of interest rates. We've got 40-year high inflation, and the most likely outcome is that all this inflation is going to fall back down. It's just a matter of time. We're going to skip through some of these other bond markets, LQD, the junk bond market, nothing exciting here. They're all tracking the US Treasury market primarily. Now, this one we do want to pay close attention to. So the 3-month US bond just about 30 days ago had dropped down to 4.5, signaling no more rate hikes. But then with strong labor data and the US banking system coming back together with about $300 billion of injection from the Fed, we've seen this climb right back up to 5%. So it's almost certain that the federal funds rate will jump to that 4.75 to 5% range in May when they do the next interest rate decision. The 2-year is trading significantly lower than the federal funds rate at 4. So I do think we're basically one rate hike away, and then we get some soft data and they either pause or start cutting interest rates depending on how fast the inflation falls. The 10-year is already down 7% on its interest rate basis over the last month. Next, we're looking at some of the most volatile aspects of inflation. We're looking at lumber futures down 6.7% in the past month and down 56% in the past year. So if this is a leading indicator, deflation is really the big theme over the next 12 months. Now, with China reopening, we want to keep a lookout on copper. They're a big user of copper. And we can see over the past year, it's still down 13%, and it's only up 1.8% in the last month. So the Chinese reopening is taking a lot more time than many expected. So we'll keep a close eye on this in the coming months. Baltic Dry Index is down 29% over the past year. This is the cost to ship commodities between continents. And you can see it's back to a historical normal. So it looks like everything's coming back to normal. Supply chains are fixing. Demand is coming back to normal. Savings are being wiped out. Wages are slowing down. We believe it's just a matter of time for services inflation to fall as well. We're not in the dollar right now, but it's interesting to take a look at it. A lot of our plays are anti-dollar. The dollar goes down, our plays go up. We can see DXY has been falling for the last month, 2.5%. The DXY index peaked out at 112 and has fallen all the way to 101. We would suspect by 2025 it'll trade down towards 90 to 80, and that's when we want to flip and really be long the dollar and short everything else. Long dollar and then long the VIX is going to be the only play once the dollar becomes too cheap. And that's because inflation will be roaring back in our face. Okay, this is the Japanese yen. There is a change in who manages their monetary policy. A lot of people were worried he would come out too hawkish and destroy markets. But so far he's come out wanting to keep interest rates negative and keep the yen cheap. Chinese currency has been flat over the last month and has been pretty flat over the last year. So no big news on that front. Stocks, buy 14 shares of FNGU. The big reason here is they own all the AI tech. And now we're seeing that the AI is going to replace a lot of jobs. Anyone who's good at AI, plus a niche specialty, probably has a super high paying job in this coming decade. And that's why FNGU, loaded with the tech giants, leverage times 3, is up 36% in the past month with the release of ChatGPT and about 8 other AI apps spread out all over these different companies in different sectors. Now, FNGU is still cheap. Over the past year, it's still down 43%. Here's a look at different indexes. The S&P 500's up 6.4% in the past month, but still down 6% over the past year. The NASDAQ is up 8.5% in the past month, while still down 6.5% in the past year. In this chart, we're looking at the flip-flop between US markets and emerging markets, which one performs the best. To summarize, when you get a really strong dollar, really high interest rates, and really high US inflation, as that falls, it becomes a tailwind for emerging markets. They typically have really nice returns for much shorter periods of time. So that's exactly what we're expecting, about a 1 to 2 year run of deflation with the dollar falling, interest rates falling, inflation falling, and assets like BTC, ETH, or EEM greatly outperforming everything else. Here's emerging markets up 4%, obviously not outperforming US markets yet. And again, the inflation has been sticky still, and the bond market really hasn't moved down in terms of interest rates much. Europe, we're keeping a close lookout to make sure there's no catastrophe from the war. So far, they've dealt with the war quite well, and their stock market's up 6.7% in the last month, and actually flat over the last year. At some point, we might get our portfolios back into uranium. We have a huge energy problem this decade. And so we love NRGU, but some alternatives would be uranium, again, down 29% in the past year. Rare earth metals, REMX, up 3.5% in the last month, but down 26% in the past year. Not in those plays now, but that's something we keep a lookout. If you want to learn more about our products and services, call Dean at 505-322-7515. Okay, very good. I'm gonna go ahead and go into Q&A, and I'll put our track record back, our trade alert back up while we do Q&A. Actually, I'll put Dean's phone number up while we do Q&A. Okay, so we got, Aaron says still a good price. What's still a good? Yeah, the portfolio is still good to build out. But remember, if you have Rebel dividends, you don't want Coinbase, and you possibly could get rid of EDC or FNGU. We're going to see a high correlation to FNGU, Coin, and EDC in terms of its relationship to Rebel dividends. But Rebel dividends will likely have the greatest volatility. So if we're making money, expect Rebel dividends to greatly outperform dramatically. If we're losing money, also expect it to lose money faster. Erin says she loves Rebel dividends. Ed says, what do you think accounted for the muted market response? Well, the inflation's still sticky. So we know like medical costs dropped negative, but that's going to probably pop back up next print. Energy's been negative, but we can look at the last month and oil's going up. The only big portion I see dropping is shelter in place. But if we look forward, that drop that we're expecting is now bouncing back up. Used cars had been falling, but now they're bouncing back up. So the certainty of deflation is still not baked in. Otherwise, the bond market would see interest rates dropping rapidly, and then the stock market would be skyrocketing up, and the Fed would be able to pause. So it's taking longer than people would think. And that's why we just had, because even though the expectation was 5.1, it came in at 5. It's still a mixed bag. Okay, very good, guys. So we will have a new webinar next Wednesday. If you're in Rebel Dividends, you'll get your dividend paid out on Monday with a live webinar Tuesday. Yeah, so tomorrow I'll be focusing on the producer price index. That's most likely going to fall. If we go look at some places in Europe, the PPI has actually gone straight down like a rock, so that's a good sign. On Friday, we'll look at retail sales. I expect those to be a little softer, but not crashing. And that's the main data to look out for until we get to, I believe it's actually May 12th when we have the next FOMC minutes. And that's almost certainly going to be a nothing burger. Expect them to do a 25 basis point rate hike. That's already priced in. I don't see any giant reaction from that. Then the next CPI, I believe, will be 2 days after that. So that'll be the next most important data print. There's also some other lesser known inflation prints coming out, the PCE. But again, the one that the market really responds to is the one we had today. And even though it did come in 0.1 below consensus, some of those we know are going to go back up. Again, medical going negative is anticipated to rise next print. Energy, which has been helping drag it lower, we know is probably going back up due to oil rising. Now, again, the oil's rising. There's kind of a double-edged sword on that. Oil's rising because OPEC has cut supply, which means there's less demand. So overall, I'm still very confident we're going to see falling inflation. I just think it's going to take a little bit longer to show up in all the numbers. Excellent. Well, thank you guys so much for joining us live, and we'll see you back next week.